All right, welcome back everyone to Capital Mindset Live. Hope you guys are having a great weekend so far. So today we have a short live stream here for you guys before we go over into our private live stream afterwards. So for all the members watching this, you guys are going to get pretty extended episodes, so to speak. So we're going to talk about the topics you can see down in the description below in that order. We're not going to really have an intro. The intro is kind of to let everyone gather around. You can ask questions now. We won't get into it too extensive of a Q&A section because we have a rough hard stop at the 45-minute mark. Rough because I'll add some flexibility in there. So the first topic that we want to cover with you guys is actually energy. And the reason why we're going to be covering energy is there's been a bit of, let's call it like a slump in sentiment, rightfully so, with energy prices falling. The excitement has veered more towards nuclear. In the last live stream, we talked about one of my favorite nuclear plays that a lot of the club members are also really bulled up on. But here today, we're going to be talking mainly about energy with respects to natural gas, oil, etc. So the first company I have brought up here, because that's the first one we're going to be talking about, is actually CNQ, Natural Resources. And there's actually, Andrew, I think you just said right before we got on here, you don't know anything about this. So this is perfect.
Correct.
I can bounce this off you.
Okay.
So this is a soft pitch of sorts. I think this is one of the more interesting plays right now available. There are other ones, but we'll start with this one. And they just actually finished a acquisition of one of the most, it's very typical of CNQ to do this, by the way, because CNQ's philosophy as regards to investment in new projects is how can we get capacity up and running at the lowest cost possible. Okay. Right. And everyone says they want to do that in theory, but then in practice, they kind of do a bunch of shenanigans. And then there's also the differentiation between the type of oil that you're talking about, whether it's, shale, sands oil, etc. So the resources that Canadian Natural Resources, I keep saying natural resources has at their disposal, their wells deplete very linearly, as in it's fairly consistent. It's fairly consistent over time. So the stuff that we deal with in the United States, in some of our newer wells, they deplete quite rapidly. And so each subsequent year, you're getting less and less and less and less. And they last about 7 or so years. And so again, that's the difference between oil sands, which is what Canadian Natural Resources. I'm just going to say CNR just to save myself the trouble.
Yeah, CNR. It's CNQ though.
I'll just say the ticker. That's CNQ. We'll keep it there. CNQ. Okay. So with CNQ, you have that as far as, kind of projecting out the valuation of a project. And there is value to that consistency with the oil sands. So the project in question that they were able to acquire recently, and they are going to take on a bit of debt in order to do so, is I forget the name of the project, so forgive me on that part, but they acquired it from Chevron. Now, this opportunity came about because Chevron wants to buy Hess, and so they divested their project that they had a partnership with CNQ. And in return, CNQ now owns the entirety of the project. So basically, effectively, they've increased productive output without actually investing necessarily in the new drilling operations. It's all up and running. They're just acquiring the other interests that they didn't have. And then Chevron's happy to do it because they want to go and buy Hess over there. And then there's also another project that should be coming up online. I believe that one should have roughly an output of 265,000 barrels per day. Again, forgive me, I forget the name. This is, all of you watching can search this. But the name's less relevant other than the actual numbers or figures that could be put out here. So that is yet another very interesting project. Within the asset that they currently acquired from Chevron, there's quite an extensive, let's say, duration on those assets. So they'll last quite some time. So there's a lot of value to be had. And then when you look at CNQ from a different perspective, on a PE basis, it looks maybe a little bit more expensive than some other ones you might find that have a lower PE. But from a cash flow perspective, it looks quite cheap. I think it trades at roughly 6 times, 7 times free cash flow. They have a typical capital return policy of mainly buybacks plus a growing dividend. So all that to be said, this is actually one of the ones on my watch list.
What causes the PE versus cash flow discrepancy?
There's some write-downs that they, yep.
Well, is that on a LTM basis, or are you talking forward? Because if there's like some one-time write-downs, it's not a big deal. Unless you're
No,
saying like
LTM.
acquisitions that have like some intangibles that they're writing down or something. Because I would think in this, if you're, I would think in a company like this, over time, PE and free cash flow should be pretty closely correlated. Because I would imagine not a lot of SBC, and then there's a
No.
decent amount of depreciation that
Mhm.
over time would be.
Correct. Yeah.
There's some
And
one-time write-downs.
yeah. Well, one-time write-downs is part of it, but there's also like they write down some of their depletion, right, over time.
Mm,
Um, but it's non-cash expenses that they account for in their expenses.
gotcha.
So it should fluctuate or normalize over time so that they kind of match. But hey,
Let's see.
at the present time, when we see the new project come online, I believe that we could see, all else being equal, oil price being equal, which is the most important input, the cash flow the price to free cash flow could come down to about five times free cash flow. It really does depend on how quickly they get that up and running and what the oil price is at that time. So if you're kind of speculating that oil prices have a near-term bottom, this is one of the names that you could play. There's also some other names. One of them that I'm really interested in are the royalty businesses. The one in particular, I mean, that one's really interesting. And that, as far as a net gas play, it's I think has the potential to do quite well. Unfortunately, for any royalty company, especially if it's an MLP, if you're not a U.S. resident, it can be quite difficult for you to actually take ownership in that. So that's actually why most of the time you see the MLP structure is a dying breed, and most of them are transitioning over to C corps because you can get a broader investor base. And frankly, that it for most people, I don't really see too much of a problem with it, but for most people, there is like a taxation issue, a complexity issue that they just don't want to be bothered with. So there is an implied discount. There's a variety of factors that lead to a discount. So a lot of MLPs have actually moved into the C corp to try to, or transition to a C corp to try to grow or extract shareholder value.
So are they primarily, just to go back, they're primarily a natural gas firm?
No,
Or are they
not
kind of,
not
they,
these guys.
they're
These guys are
75 billion. I'm assuming they're pretty diversified.
yes, they're pretty diversified.
Okay.
I was referring to just out there in the
Gotcha.
sphere of energy companies. Yeah.
So the interesting thing about them is the recent acquisition, or is it just that they're just like, you're bullish on energy in general and think that they will, um,
I'm bullish on energy in general. A timid bullishness on energy in general. There's probably certain players that I would put higher emphasis to as great capital allocators. This is probably one of them. So historically, CNQs has that reputation as the premier capital allocator within the oil space in Canada, and actually compared to its global peers, also very respectable. Because again, philosophically, the approach they try to take with every project, again, everyone says that they do this, but CNQ has actually done it, and they did it just now again. These more pragmatic or practical approaches to increasing capacity. The other project that I can't recall the name for was actually a project that they did that they worked with Shell, I believe. And so Shell and CNQ worked together to find the project, find the asset, et cetera, but they never opened it because oil prices at the time. And over time, CNQ was actually buying up ownership of that asset. I think right now the split is 90 CNQ, 10 Shell. The project has never started. And so as a capital allocator, the management team has been really smart about it. And they basically took advantage of when oil prices were low and took strong ownership over that asset. So now where oil prices are now, where they are higher than they were, back in a decade ago, the asset itself is tremendously more valuable. And that's not even producing anything right now.
So I'm gonna ask you a question that I think maybe the viewer will ask, or like the viewer is thinking right now. I know you and I are aligned on this. What happens to this? What happens to energy companies? What happens to this sector if Trump gets elected? What happens if Harris gets elected? And
political questions, love them.
I mean, because my answer is it doesn't matter. I think I'll let you prepare your answer. Here's my opinion: is that both of these presidential nominees, they should be more focused on being fiscally conservative in the environment that we're in, which is low unemployment, elevated inflation. I mean, not super elevated, but relatively elevated inflation. The reality is, I don't think either of them will be fiscally conservative. And if you're running a deficit, that means you're spending more money. That means there's going to be more just general stimulus out there, which will be bullish for any kind of commodity, any kind of energy, things like that. That's kind of my kind of broad stroke, is that it doesn't matter.
Yeah.
I think your biggest threat to anything here, and it's only because, is if one party has complete control. How was it? House, Senate, presidency? Or is that? Yeah. And I don't see that happening either way.
Yeah. I agree with you on the bullish outcome being, split government, and just like nothing really can happen. And that also it doesn't really matter who's in power, who takes power. It's irrespective of that. So one thing I will add, kind of taking us into another foray into energy, is LNG. So liquid natural gas, for a variety of reasons, is right now at its low point because it's a byproduct of a lot of these oil projects in the United States. So it's basically free. The cost is like, it's just something that just spurts out because you're trying to get to something else. And then it's at a point now where we're even having to do flaring, right? So we just burn it. Which is crazy to think how much abundance there is. And then in the rest of the world, so I think LNG prices for the United States are approaching $2, and rest of the world, we looked last night, it was over 10, so like 11. So there's a huge spread. And right now, there's a lot of projects going underway for the United States to export all this natural gas. So we're building out the infrastructure. We're set to double the infrastructure capacity by about 2028 under current projections. And so that's a lot of opportunity, but the market's already capitalized on it. So if you actually look at a lot of the well-known liquid natural gas companies, they've all rallied because the market is forward pricing this opportunity. Now, that doesn't mean that there isn't continued opportunity in the future, that the market's not just right, and it's also going to continue to be right, and these winners are going to continue to run. I'm just saying that it's something that the market has already spotted. And so some of you who were maybe a little bit early to that, congratulations. Some of you who are looking into this, be careful because there are some animal spirits, but some of them are truly going to be winners. Many of them are going to be winners, in my view, because even if you get the price and you meet halfway from the $2-ish mark to, I don't know, somewhere in like the sixes, that's a huge growth. That's huge growth potential right there. So C&Q is trading at the high end of its historical P. How do you know your thesis and price in? Well, Rob, talking more about the growth opportunity. And C&Q is on my watch list. It's not, it's just one we're talking about.
And with C&Q, because you were talking about this, is it at the high end of its historical, meaning backwards looking? Or are we talking forwards looking? Because if you're saying that there's been some one-off write-offs, I would say that's going to impact LTM pretty heavily, but shouldn't impact the forward multiple.
Yeah, and I would actually just bring it back to, it's kind of looking at it and normalizing the cash flows. But even then, like I said, even if you're trading at average or historical, you might not be getting like steep discount in a crisis, right? You can't expect that on normalized earnings, but you could get still a good opportunity if the growth on a forward basis is pretty interesting. And that comes again through, the acquisition of the new project, and then bringing online that other project. Again, the names escape me, but the one that they acquired from Chevron, and then the one that they have a co-ownership with them owning 90% and Shell owning 10% with the other project. Which that project is going to be about just over 200,000 barrels per day. I think the one that we're talking about with Chevron that they bought the rest of is going to be like 300 some odd thousand, over 300,000 barrels per day.
Mm-hmm.
So
Interesting.
yeah,
So to summarize this section, do you think that energy is a buy here in general?
I think energy is very interesting, and yes, broadly speaking, there's going to be opportunities to buy, and I think some are really interesting and haven't really moved with the rest of it. And then they also have some caveats where there could be some extra
Right.
value adds down the road, but that's more speculation.
And then another question: would you rather buy something like a Schlumberger over something like a CNR? Schlumberger is like exploration equipment, right?
Mm. Yeah, you're talking. Yeah, no, because that's not
That's
that's
very
playing a
boom
different
bust.
cycle. Yeah, it's a different
Yeah,
cycle.
I think I don't know about you. I'm much more a generalist in this space. I think if you want to get into like buying equipment and those kind of things, I think you want to be more of a specialist or someone who really knows it well and can read the cycles and where we're headed well. I can't. I think you can play more of like the generalist companies. Like
Yeah.
a CNQ is generalist. They do the output, the production. Buying the equipment companies is more boom bust, just like buying semi equipment companies or things like that, where you're trying to read where we at in the cycle.
Mm.
I tried
I
to do a smooth transition, didn't really work.
no, I just think it's like it's kind of like the semis when we talk about semis, right?
Mm-hmm.
And is that what you're trying to transition to?
Mm-hmm.
All right. Well, that's actually perfect. Talking about different cycles and analyzing two different cycles.
Yeah.
So let's talk about ASML. All right. So the topic of the conversation is titled "Semi Bear Market Ending," and I know some of you go like, "Bear market semis, whatever." No. It's like seriously, we've been in a bear market for a little bit, masked by China investment or China demand. So there's a couple companies you can kind of go out and see the specialized manufacturers and see how what they're talking about, and you can see that their business segments, particularly related to semiconductors, are down like 25%, 26%, 30%. And they're in this like trough period where now they're projecting again for that to pick up again in 2026. You listen to TSMC, one of my largest holdings, and you hear what they have to say. They have nothing but praise about 2026 in terms of capex. So I say praise because I'm talking about in positive light to other companies that sell equipment. So TSM and Micron is the other one I listened to. Both of them had the same thing to say. Well, you do also have Samsung and Intel delaying some of this capex. I don't think it's just going to be deleted, but it is a delay. So with ASML, Applied Materials, KLA, and Lam Research, you have different risks. And I actually did publish a tweet. You guys can go to my Twitter. You guys can check it. I did a big little write up on each of these companies.
A big little write up.
Big little write up. I'm forgetting how to speak. So, Lou Gator afternoon peasants. So with ASML, they reported earnings a little bit early. They're guiding for the lower end of next year's revenue, which is a 30 billion. But they're still projected to still pump out some growth here. And then following 2025, and I don't think what the analysts are estimating is if the new machines start to get adopted, because the incremental price increase from the old gen, or let's say call it current gen to new gen, is quite dramatic. So we're talking 200 to 300 million to over 400 million, well over $400 million per machine. It's just the new generation, the new tech isn't being adopted right now. The only one who I think has bought any is Intel, but TSM hasn't bitten yet. But if they will start biting here in the future, then those projections I think are underestimating, because that only assumes the current gen.
So here's my thing with these companies is, once again, I am not an expert in this sector. I think like understanding, and I was saying this about like Schlumberger, but it's going to apply for ASML, CLAC.
Clack.
Is
I
it,
love Clack. When people
is
say
it
that.
LRX? Is that the ticker?
Yeah, LRCX.
LRCX.
Memory research.
Yeah, is to know the equipment that they're manufacturing, knowing who the buyers are, knowing the buyers are at in the cycle, knowing what they're doing, all that. You kind of have to either really know the space well or know someone who knows the space well who can tell you what's going on. I don't know the space well. I know there's people in the community that do, but I haven't actually looked at this. And just be careful, I'd say, is like, especially if you're on FinTwit, if you're on YouTube and people are saying like it's an obvious buy, we're still in the middle of them trying to figure out demand. And always be, I'd say, a little bit nervous about companies that look really cheap that are cyclical. So I don't know how expensive they look. I don't know what the projections are. But if they're starting to look cheap, that could mean that they're going to have continued demand weakness. Because what are these guys looking like on a longer time frame?
LTM. Oh,
Just like, okay, so yeah, like they're not up at all year to date, 23. So they're underperforming the market.
correct.
And I can see this having continued weakness for I don't know how long, but some time. Like I don't think it's a wild thought to say if you continue to have a decline in or just a pullback in semis and everything except data center, which is what's happening right now, you could still have underperformance in these
Wait,
names.
I wanna counterpoint something. The decline in semis, everything but data center was already there. Like
Right.
That's
But
what a lot of people were kind of hinting at. They're like, whoa. This rally from all these semi equipment, it's so premature. It's only being driven up by this excitement, this hype for these other things. And the numbers were being masked by China acceleration.
Someone was pushing back on me on this. And I said this, and it's really funny because I said, I don't think semicos right now are being priced like they're cyclical. They're being priced like the cyclicality has ended. And someone was like, what do you mean by that? And I was like, look at these companies. Like they should be being priced like they're still a cyclical company and they're getting multiple expansion way early. That's what I thought. And I thought that like data center really masked and didn't make it clear what's going on. Yeah, NVIDIA doesn't count, okay? Because NVIDIA gets so much from data center. But you look at these other companies that are more broad-based, and you can see what happened to ASML. Like you said, the rally was premature because semis are really going through like a trough in demand right now. You can see that in cars. You can see that in computers. What are the other things? Like a lot of other automated things that use
Connectivity.
connectivity. But they were being held up because data center demand was so strong. But that can only keep you sustained, especially in an equipment supplier for so long, because I'm assuming, and I don't know these guys that well, is that if you're supplying equipment, well, if NVIDIA buys your equipment one year, yeah, you get a lot of demand from NVIDIA that year. They don't need to come back to you the next year and buy it again.
Well, not NVIDIA, but yeah.
But I'm just giving an example, a very broad example, because I'm just trying to give an example of data center demand.
Yeah.
So if someone's buying you the equipment, to make the stuff for DC chips, well, that's great. But the people aren't coming back to you to buy stuff to make the chips for cars, for connectivity, for phones. And as an equipment provider, that data center demand only lasts for so long before the guys say, yeah, we don't need more equipment from you. And it's like, oh shit, now we don't have any demand and we are trying to extend to multiple. So that's how I kind of felt. And like I said, I am not a specialist in this space, but that's what I thought looking at it.
Yeah. No, but I'm kind of just pushing the idea that we're actually close to the end of that cycle and then re-entering the resurgence of the other cycle. And
yes,
I'm using other players to help me understand that. But
okay, counterpoint.
Mm-hmm.
What happens if, you get a resurgence in the more broad cycle and then the DC demand falls off?
That DC demand is not going to fall off. That's the bet I'm making.
Okay, that's the bet you're making. But if that happens, this thing's going to fall more.
Yes, for sure. Well, potentially. But it would be something to consider as a risk. I don't think it's going to happen. At least for the next 2 years, for sure. I don't think it's going to happen. But yes, let's put that in as a risk that might mitigate how large you make these positions. I'll
Well,
grant you
remember,
that.
for these companies, you don't need data center demand to die. You need the demand for what the equipment that they're providing to data center to die.
Correct.
So all you need is a pullback in data center demand, and then these guys might not be given any equipment orders, if I understand it correctly, or like it's not proportional necessarily. That's why, like, I feel like these things are hard to buy, because if you don't know the space that well and you're just an idiot out there being like, well, it's down, semis will come back, and you don't understand the space very well, I think you can get caught off sides very easily.
Yeah, you can get.
I'm not saying you're that. I'm just saying, like, we have people in the CM community who know the space very well, who follow it very closely.
Some of
have
them
a
holding out on us. They have like 20 years experience, by the way.
Yeah, but
Like,
we're not going to
freaking
talk.
hell. Like,
But I feel like if you're a generalist in this space, or you're just a regular retail investor trying to make bets on ASML, etc., you're better off probably buying the index, because there's a good chance of a cutoff side. But
thing is, though, at least from what I gather here so far, and it's not going to be all of them. Okay, so here's the thing. So ASML, potentially, you're right, potentially, but adjacent plays will kind of go off a slightly different focus points. Like, I think applied materials, or LRCX as well. Well, LRCX has potentially a near-term catalyst in memory investment. And based off of what I hear with Micron, it could be that they're actually going to get a short-term boom here. And they might have a slight deviation in performance from that of applied, even though they're going to be highly correlated. Like, those two are extremely highly correlated. You can almost like replace and interchange them, and you'll get roughly the same performance, small deviation. Arguably, right now, LRCX might be in a better position. There is a bit more risk with LRCX with regards to how quickly China drops off and how slow it takes for everywhere else to pick up, because about 40, almost 50% of their revenue in the last quarter was like from China. It's declining. Wait, no, I think it's already declined. A couple quarters ago, at least, it was like getting up there for China.
I want to say, I'm just reading some of the comments, and they're saying, historically buying crashes in ASML and CLAC, LRCX has never been a bad idea. My counter would be, buying a top for them has never been a bad idea either. I wouldn't use that as a point to say this is the time to buy it. Like, you look at any company that's up 25,000% since it's IPO'd, and yeah, I mean, you're right. Buying a dip in that kind of company's never been a bad idea, but I wouldn't personally use that as like a way to look at this.
I view it kind of now this way. So the multiple, it doesn't look cheap, is a thing, by the way.
It doesn't? Okay.
No. So you don't have like a mid-teens multiple on these guys right now. During a boom, like an absolute boom, potentially, I think a lot of things have been distorted now, though, because of the AI cycle, or if you want to call it that. Let's just call it the data center cycle. I prefer to do it that way. But we do technically have traditional DCs and then these new DCs to kind of separate the two. Stuff that's used for this new AI, and then older, traditional data centers used for, other stuff. But the way I'm seeing it, and I know that you presented a very good risk because it's a unknown. It's a what if. What if this happens? Yes, okay, that's a problem, or could be a problem. But the way I'm thinking it's going to happen is that DC or AI spend, let's just call it AI spend, actually, to create a separation. AI spend and traditional. AI spend has this new cycle that we have to analyze, and we don't really know what the end is, but we kind of have an idea for it just based off of some of the commentary. TSM believes it's couple years down the road. Maybe they're not lying, but maybe they're being overly optimistic. They don't actually have a reputation of that, which is funny enough. But anyways, so TSM says something like that. We don't see any hints from any of the hyperscalers that they're slowing down. Like, have you heard any of them say we're reducing capex or only increasing capex? increasing spend, increasing capacity?
Increasing out of all these.
Yeah, all of them increasing, right?
I'm not necessarily disagreeing with you. I'm just trying to say like a cautionary thing is that I guess I'm trying to like say let's think through this and be more like I don't I'm going to use this word that triggers people. We need to be more nuanced than it went down so I buy and it will go up. Like and I think you are being more nuanced than that. But I just want to say in general in the stock market don't look at companies that have historically been winners and say, "Oh, it went down so I'll buy it and it'll go up." I mean, I think that's a very, and I'm not saying you're saying that, but I think that's the prevailing thought people are having on this right now. And I think there are risks here. And as you know, I don't buy semicos at the, I'm a very hands off because I know that I don't know them.
Here is also like the unpriced, going back to what's kind of unpriced when I look at, what estimates for ASML are implying. Estimates for ASML are implying basically some sort of continued of the norm as regards to what units are being purchased. If the new gen starts to really get picked up because you can package a bunch more transistors in theory into a even smaller amount of space, and that becomes vital to having superior silicon or silicon supremacy. Oh yeah, then ASML is like, you're gonna be like, oh, it was definitely a buy here.
see what you just said. I didn't understand any of it, and that's why I don't buy semis. About like the technicals on why their thing in silicon supremacy and how like I know ASML makes equipment for semicos. I don't know what their equipment does. I don't know why you need it, etc.
I'll say it like how some people say, explain it like a fifth grader. They are the center of everything. They are the thing that makes it all possible, right? Without them, there's no chip. Without them, there's no GPU. Without them, there's nothing. You need their equipment in order to do any of this in the first place.
Okay.
They're the starting point when we talk about, hey, let's produce a GPU, let's produce a CPU. When I'm not saying they're the raw materials. Someone will say, oh, that's the starting point. It's like, no. They're the actual machine doing it, and they're the only ones.
So they're the only ones. Well, then what does CLAC and LRCX do?
Supplementary services on top of that. Not services, but products on top of that. So, for example, KLAC does a lot of the measurements. I won't use the jargon that they use. I'll, again, use like fifth grade jargon. They do the measurements and they do the checking, right? They check to see, oh, hey, that looks good. That's according to our standards, good to go. And they also make sure, okay, the unit of measure, the measurement, okay, that's good to go. Good. And they have about 90% or so market share on top of that. And then things that Applied does, it's a bunch of other things that Applied will do. Like literally, if you look at the chart, there's like a chart that we shared in the club. It was like, it basically showed throughout the entire process who controls what and what's the market share, right? In every step of the process. And you'll see like ASML is like hugely concentrated in one thing, but it's like the starting point. It's like, that's where you start to think about it. And then KLA dominates 90+% of basically almost towards the end of the process, the checking itself.
Gotcha.
Applied Materials is like almost all over the place and has large market share in a variety of different products. They're probably, you can think of as the most diversified player. And then LRCX has, they have a dominant position, and I think was it two? They're also in a bunch of things, but they have like a dominant position in like two of them. They're also really important, mainly in like memory stuff that goes with memory. So that's why I say like with something like Micron, when they say, oh, we're going to be increasing CapEx here in the near term, it may be more beneficial. Not that Applied won't benefit. That makes it sound like they won't benefit. No, they will benefit too, but it might be a little bit more of a boost to something like Lam Research than anything else.
Gotcha. Interesting.
So, yeah, like with ASML, you can't get around them. Like there's no going around them. There's no alternative really. There's some like pie in the sky alternatives that are out there that people are saying that like these moonshot ideas of kind of circumnavigating them, but no. And China has been trying to with mixed success, depending on who you ask. Some people have opinions that, oh, it's going to be great. Depending on what news sources you look at, how much of that is propaganda, how much of that is real, I don't know. So the point is that with the new equipment, and they're always trying to, reinvent themselves in a way, bring out the new generation, just like, with a consumer product, you're on your iPhone, they come out with the new generation. And so the newest generation is even more expensive than the last generation, but as advertised, it's supposed to be far better, right? But the problem is at the present point in time, and you just have to listen to TSM, and I don't think they make it sound complicated as far as like when they explain it to their shareholders. Of course, they go into more detail, but you can kind of get the gist of it as saying, well, our customers don't really see a need for it right now, so we don't want to buy it. Intel is trying to, because basically a long time ago, Intel was jumped by TSM because TSM took a not a gamble, but a gander, and invested in the new stuff from ASML quite heavily, and Intel didn't. And now TSM is where they are today. But it's far more than just buying the machine. That makes it sound like, oh, you just buy the newest machine and you're good to go. No, there's a lot of complicated processes that TSM, obviously it's like unique to TSM, and how they're able to actually have the output that they do have, which actually makes it even more valuable, because like the success output for TSM is so much higher than everyone else's. What I mean by that, and to simplify that, is just like how much of the silicon that goes out from them is usable, right?
Gotcha.
For TSM, it's extremely high yield. For everyone else, it's So
you want to hit the last topic? I don't know if you want to like kind of wrap up this segment. It seems like you're thinking it's a decent risk to return proposition here for these semi equipment codes.
Yeah, and I think like for myself, I'm doing a basket approach. I'm likely to just assimilate a basket approach and then not make it too large of a position in my portfolio. But if the market does end up rewarding it and I'm right on this, I won't necessarily punish it and like bring it down. I'll just kind of let it sit there and ride, and it'll be just like a core thing in my overall portfolio. Like I'm looking to make the whole thing all together, maybe 5 to 6%, and leave it like that. So gotcha. That includes ASML being in there with a few others. All right, let's get into the last topic. The last topic is more of a fun topic. Then we're going to move on to the private stream, or ICOM, for our club members. Is the market overvalued? Is the market overheating, Andrew? Should we sell?
You know what's interesting about the market right now? So what was the bear thesis on the market in the first half of the year?
All the performance is driven by the top stocks.
Right. What's happened in the third quarter?
A lot of the underlings have picked up in performance.
Right. So Mag 7 hasn't really done much in the third quarter. Right. So if you look at, I'll just give you an example. And I just pulled up the ticker RSP, which is the equal weight. So let's say you look at that third quarter, that's up 11.5%. How much is the SPY up in the third quarter? SPY is up 7.2%. So what you're seeing actually, I'd say, is like it's bullish. It's an expansion of the bull market to everyone else, because that bear thesis of the gains being very concentrated has fallen off. I mean, look at a chart of, and I'm not saying that these companies are overvalued. I'm saying it's actually fairly bullish. What's happened is that the proposition of the bear case that the market's so concentrated in gains is now kind of falling off. I mean, other companies are starting to catch the bull market, which makes sense, because when you look at these mega caps, what they basically represent is, for a lot of people, safety. So they go up first as people are worried about, is there still a bear market, et cetera. As the bull market expands and goes at everyone else, the rest of the market goes up. Maybe these guys underperform as people are starting to move out of the safety of those into other companies they might find more attractive at the time. Do I think it's overvalued? I mean, I think certain sectors are. I think other sectors aren't. I don't know. I hate that question because it's like, I here's what I'll tell you is, if you're buying a VOO or an SPY, you don't care. You just keep buying, and that's what most of you should be doing in most of your accounts. If you're picking single stocks, I think certain sectors are overvalued. I think certain sectors are undervalued, and I think you just need to know where to be looking. Like, why? I mean, I don't know. I don't look and say broadly like this. This isn't a 2021. And the other thing too is, if you think about it, if you look at where we are from the highs, how high are we from the 2021 highs?
Oh, I can pull that up.
20%.
Yeah, at this point, 24.
Okay. And how much inflation have we had in that time?
I can't recall.
Cumulative. I want to say it's something like probably cumulative 15 to 20%.
Dex is trying to get us to talk about a certain conversation.
The SPY PE ratio is high. I don't know what that means. Is that about harmonic averages?
Oh, you remembered the harmonic average.
I don't know if that's what he's talking about or if he's talking about something else. But
no, he's talking about just the general argument about the price to earnings for the index being higher than it's been in historically. Which I think, by the way, this is a point in time for me to say this. It might sound harsh, but if someone says that, just don't listen to them. At least with topics regarding investing.
I mean, yeah, you're going to have a higher PE than 2000 when the biggest companies were all energy cos.
Well, no, 2000.
Okay. 2000 is a bad example.
Yeah, 2000 example.
2010.
Yeah, yes. So the constituency, I keep fighting everyone about, it's about the constituency. It's about actually thinking about what you're saying and the facts at hand instead of just saying random crap out of your head. But yes, the multiple change is by itself a fact that's frankly kind of useless because it ignores all of the, let's call it context that's needed. So in the case of, the US index, the constituency is completely different than it was 20 years ago. So just off of that, okay, well, what does that mean? Well, explore that a little bit. Who are the top companies 20 years ago? Who are the top companies now? What's the difference in their business models? What's the difference? Are they capital light models? Are they capital intensive models? Does that not have inherently a different multiple? Have you guys if you guys just started investing yesterday, or do you guys know that, for example, an oil company, an energy company will typically trade at sometimes a 10 PE, it's pretty common, 12 PE, 13 PE. And then a bank will trade somewhere around the same. Like I think JP Morgan Chase right now trades at like 12 times earnings. So
yeah. The other thing I think people don't look at or don't take into consideration enough is look at the balance sheets of these companies. I mean, dude,
insane.
Is there a single company in the top 10 other than Tesla? We'll throw that one out maybe. But even Tesla, I think they have an awesome balance sheet. Now that I say that, that doesn't have an insanely good balance sheet. So you have Apple, they have some debt, but maybe that's the worst one actually. Yeah. Nvidia, I think, is super solid. Amazon is. They like to keep their cash low and reinvest, but they still have a good balance sheet. Google's amazing, Microsoft's amazing, Berkshire's amazing. I don't know Broadcom. I mean, is United Health the other one? They all are amazingly strong balance sheets, and so there's less risk of the company, really having hard times and having to make bad decisions. So no, I don't think it's overvalued. I think if you're saying should I go all cash? Should I do something like that? Should I sell out? Should I reduce holdings? If you're just a person that's buying the market, no, you should be 100% invested at all times.
Yep.
And we're running up on time here. I want to keep us to our time. One quick question, and then I think we go to private stream.
Yes.
And that's by RKAWKAPS. No idea what that name phonetically comes out to. But for a 34-year-old looking to retire by 45 with an all stock portfolio, how would you allocate SPY/VOO versus individual stocks? I think this is more a question of how much risk are you wanting to take?
What's your income?
What's your income? But like, do you do single stocks? Like, is this something you're just foraying into? I would put it this way. There's a 90% plus chance you should just be 100% in the index. From my view. If you're someone who enjoys digging into companies, likes picking individual stocks, things like that, and you've been doing it for a long time and have a good track record, well, then maybe don't worry about it. But if you're looking to retire soon, you also have to start looking at those single stocks, how much you allocated to one single stock, how much you allocated to, what's your risk there? You're getting, I mean, the equivalent would be saying, I'm 56, I want to retire at 67. How much risk should I be taking? You're asking somewhat of the same question. And I would say try to reduce risk. Don't be super allocated into a single stock. Try not to be allocated into single stocks in general a ton. But really, it's hard for me to say without knowing your story that well.
Yeah, be super tough. But it's kind of like the study that we went over in the last live stream. Where we are now or how things have shaped up to be, there is stands to reason that the following statement is probably not unreasonable to think. And that statement is, in today's market, there is a great reward that awaits those who try and succeed, but that the probability of trying succeeding is also really small. Kind of an obvious statement.
Yeah.
Kind of an obvious statement, but yes. So can someone in theory, pick individual securities and retire within 10 years? Oh yeah. Yeah. The data suggests that performance is becoming more and more concentrated, and that implies that you need to have some sort of additional bit of combination of luck and analytical skills to find those opportunities. And then that the opportunities are becoming more and more outsized when you do hit. But then it also implies that there is a greater plurality of stocks that if you purchase those, you'll have a higher propensity to underperform. At least that's what the prior live stream what we talked about in that study suggests.
Yep.
Yeah. So, oh, dude. Well, he just gave us the numbers. You're freaking set. If those are your numbers, dude, you're set. No, seriously. So just keep doing that. If you did,
well, yeah, and it depends on what percentage that is of your income.
No. Well, he's saying 400, and he's saving.
No. But I'm assuming the 400 is what he has in investments.
Oh yeah. So now, we're having a completely different conversation now. But
no, my point is, what if you're making $5 million a year and you save 200,000? Then you're gonna need to you're going to still work and save for a while. If you make 300,000, if you make 500,000 a year, you're saving 200,000. You're going to be able to retire pretty quickly.
Yeah. Well, he at least can get himself into a fairly above average lifestyle.
So I have one last question then before we sign off: is what do you do and can I get a job there? And then
no, because if you have 10 years now, I mean, yeah, and if you have just average market rate of return, if you have even slightly above average market rate of return, I mean, you'd be pretty set. Yeah, saving 200 a year, you'd be pretty set. So that's a good problem. Oh, look, dude, he's even talking. No, total house income.
Well, there you go. So yeah, there's a calculator. Hold on. I'm sure
working
he's
in
familiar
tech.
with it. I think it's a fire calculator by Mr. Money Mustache. He's probably familiar with it. Let me see if I can find it real quick for you. And then we will really get off of here. Okay, yeah, there's a thing based on savings rate as a percentage. And he goes through the calculation here. I'll just put it in the chat. And you can copy and paste this into your browser. But there's actually a pretty good like analysis there on here's how much you save. Here's how long until you can retire, basically. And I can't remember what he uses as a estimate of portfolio returns. But you're looking at fire, so I think that's kind of up your alley. So, anyways.
Oh, and I don't know if you're a club member or not, but if you are, there's like you're in tech. There's a lot of people in our club that are tech. So I was wondering if you are or not. But anyways, yeah, no, you'd probably be set. All right, so I think we can wrap up and then go to the private stream.
Perfect.
All right, so with that being said, thank you guys so much for watching. If you enjoyed this live stream, feel free to leave us a like, share, subscribe. If you're on Twitter, retweet it, heart it. And if you're also curious about joining the club, the link should be in the description down below. And yeah, we'll be seeing you guys on the next one.